Hello everyone. Welcome to one more video on cost analysis. This is chapter 6 from engineering economics textbook, and from that chapter, I'm solving some example problems. So here is one problem, that is 6.31. So just have a look at this question, read the question, try to understand what is the stated in this question, and how to solve this question. What is the thing? So that you can give an attempt, and you can compare your answer with my answer. Okay, so let's begin the analysis of this. You can pause the video now, read the question, okay, and then you can compare your answer. Okay, so let's get started. So here what it's saying: a company is currently paying its employees 0.56 per mile to drive their own cars on company business. Okay, so the company is paying the employees. Okay, so let's write it down. Payment $0.56 per mile. So here we got this. The company is considering supplying employees with cars. So instead of paying the money for the employees who drive their own cars, instead of own car, now company is considering supplying the employees with cars, which would involve purchasing at 25,000. So what is the cost of the car? Okay, per car, it is $25,000 with an estimated 3-year life. Okay, so the number of years is only 3 years. Net salvage value of 8,000. Salvage value is $8,000. Taxes and insurance cost of 1,200 per year. Taxes $1,200 per year. So I made use of this information, and operating and maintenance expense of zero point 0.3 per mile. Okay, so O&M $0.3 per mile. If the interest rate is 10%, okay, so I is 10%. And the company anticipates the employees' annual travel to be 30,000 miles. So annual travel 30,000 miles. What is the equivalent cost per mile neglecting income taxes? So question what is asking is equivalent cost per mile. Now if the equivalent cost per mile comes to be less than 0.56, then we should go for investing in the car. If the equivalent cost per mile comes to be more than 0.56, then instead of paying, instead of providing car to your customer, you can, to your employee, you can ask your employee to drive their own cars and just pay the $0.56 per mile. Okay, so that is the idea. Anyway, so let us now come to, now we simply make a cash flow diagram. So that is the first step usually. So what is the cash flow diagram? So I can have 0, 1, 2, and 3 years because it's a 3-year thing. So initial investment is $25,000 and the salvage value is $8,000. Okay, so I got the salvage value and initial investment. So this one is done and this one is done. 3 years I've taken. Now tax is 1,200 per year. Okay. So and O&M cost is zero point 0.3 per mile. Okay. So how many miles per year is 30,000? Okay. So here I will write O&M cost is zero point 0.3 into 30,000. So that will be $9,000 per year, right? Yeah. So zero point 0.3 of 30. So $9,000 per year. And taxes will be 1,200 per year. So total cost per year will be 9 plus 12. Okay, so 10,200. Okay, so here in the first year, $10,200. So what is this one? That is 9,000 for O&M plus 1,200 for taxes and insurance. Similarly, the same thing, 10,200, again same thing, 10,200. Okay, so this, I'm sorry, here it went out. Okay, so okay, so we covered the taxes, we covered the O&M, we covered the, okay, so I think we covered everything. So uh, this is my, what is that, costs. Okay, so now let us calculate the present worth and annual equivalence. Okay, so how to calculate the present worth? Okay. So present worth, it will be minus 25,000. Already it is there in the initial year, in the 0th year. Next, the salvage value. Okay, so that is positive. So this is negative, but the salvage value will be positive. 8,000. Here I need present value given the future value, and the interest rate is 10%, and the duration is 3 years. Okay, so this is what I need to multiply it to get the equivalent present worth. Next, I have three equal payments. Three equal payments are there. So 10,200 multiplied by, I want the present value given the three equal annual payments at 10% and 3 years. That's it. So this is the calculation to find the present worth. So let us do it. So that will be minus 25,000 plus 8,000 multiplied by a factor plus 10,200 again multiplied by a factor. So what is this factor? So I need to refer to my tables again. So again, I'm telling this can be easily done in Excel, but since for the exam purpose, we are practicing with this. Okay. So I'm referring to this P by F sheet, find P given F, and I'm referring to 10% 3 years. Okay. So 10% 3 year, 0.7513. Uh, that is the ratio. Next, I have to refer to P by A. So let me find the sheet. Yes. So this is the P by A sheet. So again, go to 10% and go to 3 years. So here the factor is 2.4869. 2.4869. So now let me calculate the present worth. Okay. So here minus 25,000. Sorry. First I will do this multiplication. So 8,000 multiplied by 0.7513. So 6010. 6010. This is positive. I'm sorry, here this will be negative. Okay, so which is, uh, again, sorry for the confusion, this will be negative. Minus 25,000. And this will be minus 10,000 multiplied by 24869. I'm sorry, 10,000 multiplied by 2.4869. 24,869. So now I got this. So now what is the total? Okay, so for this I'll apply minus sign, then plus 6010 minus 25,000. So it is now costing 43,859 dollars. So this is the present worth. Now from present worth, I can find the annual equivalent cost. Annual equivalent cost. So what is the annual equivalent cost? So minus 43,859 multiplied by, find A given P at 10% for 3 years. Okay, so that is it. So here minus 43,859. So instead of multiplying, I'll go for dividing, and then I'll go for P by A, same that ratio. So which is something like 2.4869. 2.4869. Already we calculated that. So what is that? So divided by 2.4869. So that comes to 17,000 minus 17,636 dollars per year. Now, what is the cost per mile? So every year, so the cost per mile. So this minus sign I'll remove it. 17,636 divided by 30,000, because I'm traveling 30,000 miles every year. Okay, so divided by 30,000. So this comes to $0.587 per mile. Now you notice here $0.587 per mile is the annual equivalent cost. Okay, so this is AEC. Whereas if I go to the top, so the payment to employee is $0.56 per mile. So for the company, this option is actually cheaper, because if you compare, so here this cost comes to 0.587, whereas this cost is 0.56. So 2.7 cents you are paying extra, if and you have to take the bothering of purchasing the car, and then taking care of the uh, taxes, taking care of the operational maintenance. All this cost will be there for the company. So instead of doing all these things, I think the company should go with the present option. So here, uh, if the interest rate is 10% and the company anticipates employees' annual travel to be this one, what is the equivalent cost per mile neglecting income taxes? Okay. So this is the importance of this annual equivalent cost analysis. You can take a decision whether we should go for this or not. Okay. So because of this, we are able to take a decision, and the recommendation is the company should continue its present policy, pay 0.56 per mile to drive their own cars, okay, to the company. I hope this question was interesting. I hope you might have learned something. Thank you. See you in the next video.